Bella and Arya invest the exact same $625 every month for 35 years. At 63, both see $1,125,000 in their retirement accounts. Bella keeps every dollar. Arya cuts a $247,000 check to the IRS. That is not a typo. That is the actual cost of a single checkbox clicked at 28. One choice, Roth versus Traditional IRA, created a $250,000 gap. This is the complete breakdown of which is better for your situation. The Roth IRA versus Traditional IRA versus 401k sequence. When each wins, what the math looks like at your specific tax bracket, how the Rollover IRA fits in, and the single number that decides everything. Both are individual retirement accounts, tax-sheltered buckets where your investments grow faster because the government gives them special treatment. The money inside can be invested in index funds, stocks, ETFs, whatever you choose. The bucket, not the investment, is what changes your tax outcome. Traditional IRA, pay taxes later. You get a discount on your taxes today, your money compounds, and every dollar you take out in retirement is taxed as income. Roth IRA, pay taxes now. You get no discount today, your money compounds, and every dollar you take out in retirement is tax-free. The only difference is when you pay tax, before the money goes in or when it comes out. Same age, same salary, same $625 a month, same 7% return, same 35 years. End result, same $1,125,659 account balance. But Bella keeps it all, and Arya owes $247,000. That is a fully paid off car, a house down payment, or years of retirement income. Gone, just from picking the wrong account type. The $863,000 in growth inside Bella's Roth IRA was never touched by the IRS a single time during those 35 years. Arya's Traditional IRA grew the same amount, but the IRS treated every dollar as taxable income at withdrawal. At a 22% rate, that is a $247,645 tax bill on money Arya already watched compound for 3 decades. Traditional IRA wins when 3 things are true at the same time. 1, you are in a high tax bracket now. 2, you expect to be in a meaningfully lower bracket in retirement. 3, you actually invest the tax savings or use them to pay off high interest debt, not spend them. If you are in your 20s or 30s and expect your income to rise, that is usually a Roth story, not a traditional story. Most people in their peak earning years are not suddenly in a dramatically lower bracket at 65. They maintain similar spending, similar income, often higher Social Security and investment distributions than they expected. The idea of dropping from 22% to 10% by retirement is more hope than plan for most people. The Roth locks in today's rate on your contributions. The traditional is a bet that your rate falls significantly. For people earlier in their careers, that bet usually loses. Most financial advisors, Dave Ramsey, and nearly every major personal finance voice recommends Roth for most people, and the reason is not complicated. When you are young, you are almost always in your lowest lifetime tax bracket. Every dollar you pay tax on now is a dollar that will never be taxed again, no matter how large the account grows. The Roth turns that small contribution into a tax-free snowball. Ramsey's position is simple. Pay tax on the seed, not the harvest. If your $625 a month grows into $1.1 million, you want to have already paid the tax when it was $625, not when it is $1.1 million. The counterargument that you should defer taxes and let the full amount compound is mathematically correct only if your retirement bracket is meaningfully lower. The Roth wins in every scenario where your current and retirement brackets are the same, or where your retirement bracket is higher, given where tax rates are likely heading with long-term U.S. deficit obligations. Most analysts expect rates to be higher in 20 to 30 years than they are today. Paying today's rates is the hedge. Now run the math for your own bracket. The account balance at 63 is $1,125,659, regardless of which account you choose. The growth is $863,159. The question is what percentage of that the IRS takes. If you expect to be in the 12% bracket at retirement, traditional take-home is $990,580. Roth still wins by $135,000, but the gap is smaller. If you expect to be in the 22% bracket at retirement, traditional take-home is $878,014. Roth wins by $247,645. If you expect to be in the 32% bracket at retirement, traditional take-home is $765,448. Roth wins by $360,211. The break-even point for someone currently in the 22% bracket is a retirement tax rate of about 5%. That is below the lowest federal income tax bracket in existence. In other words, your retirement income would have to be almost nothing for the traditional to win if you are paying 22% today. For most working adults, that scenario is unrealistic. The one situation where traditional genuinely wins, you are in the 32 or 35% bracket now. You plan to have modest retirement income below $50,000, and your retirement bracket drops to 12% or lower. In that scenario, the traditional saves you real money. Outside of that specific combination, the Roth wins. The 2026 contribution limits and income rules. IRA contribution limit, $7,500 per year. That is $625 a month to max it out. 50 or older, you get $8,600. Roth IRA income limits for 2026. Single filers can make full contributions below $153,000 in modified adjusted gross income. The contribution phases out between $153,000 and $168,000. Above $168,000 as a single filer, you cannot contribute directly. Married filing jointly, the phase-out runs from $242,000 to $252,000. Traditional IRA has no income limit for contributions, but whether your contribution is tax deductible depends on your workplace plan situation. Single filers covered by a 401k at work see the deduction phase out between $81,000 and $91,000 in 2026. Above $91,000, with a workplace plan, the traditional IRA deduction disappears entirely. You are contributing after-tax money, but not getting the Roth's tax-free withdrawal. That is the worst of both worlds. Avoid it. If you are over the Roth income limits, the path is max your employer 401k, match first, then use a backdoor Roth. You contribute to a non-deductible traditional IRA, then immediately convert it to a Roth. It is 100% legal and widely used by high earners. The conversion triggers a small tax on any growth between contribution and conversion, which is negligible if you convert quickly. One important caveat: if you already have money sitting in other traditional IRAs, the IRS applies what is called the pro rata rule. Instead of converting just the new non-deductible contribution, the IRS blends all your traditional IRA balances together and calculates the tax proportionally. If you have $100,000 in a traditional IRA from a previous job, a backdoor Roth gets complicated fast. Talk to a tax professional before executing this if you have existing traditional IRA balances. 3 income scenarios that cover most of the people watching this. Earning $80,000 a year, 22% bracket, you are below the Roth income limits, probably in a lower bracket than your peak earning years, and almost certainly headed for a higher income over time. Open a Roth IRA, max it. This is the clearest Roth case. Earning $140,000 a year, 24% bracket, still below Roth income limits as a single filer. Your retirement bracket depends on how aggressively you build assets, but most people at this income level stay in the 22 to 24% range at retirement. Roth still wins in that scenario by over $270,000. Earning $200,000 a year, 32% bracket, above the Roth income limits for single filers. Max your 401k to the employer match, then backdoor Roth. If your retirement income will genuinely drop to 12% or below, traditional IRA makes sense for the deductible portion. If your retirement income stays high, the backdoor Roth protects you from a larger tax bill later. What the 401k and Rollover IRA add to the picture: the 401k limit for 2026 is $24,500. It comes through your employer and gets deducted from your paycheck before taxes. It is functionally similar to a traditional IRA for tax purposes, though with different rules on loans and required minimum distributions. The sequence that maximizes your outcome: 1. 401k up to the full employer match. Free money with an immediate 100% return. Nothing in investing matches it. 2. Max your Roth IRA. $7,500 a year in your own account, outside your employer's control, with tax-free growth and no required withdrawals, ever. 3. Back to the 401k if you still have room. The $24,500 limit gives you significant additional space after maxing the IRA. The Rollover IRA is a separate account type that comes into play when you leave a job. When you leave an employer with a 401k, you can roll that money into a traditional IRA to preserve the tax advantage status. No taxes, no penalties if done correctly. The transfer goes directly from the 401k to the IRA without you touching the money, or you have 60 days to complete it if you receive a check. Once the money is in a traditional IRA from a rollover, you can convert it to a Roth IRA, called a Roth conversion. You pay income tax on the converted amount in that tax year, then the money grows tax-free forever. This is a powerful strategy when done in a low-income year, a gap year, early retirement, or a year between jobs, because the tax bill on the conversion is smaller. 2 more differences that most people only discover when they actually need the money. With a Roth IRA, your contributions, not the growth, just what you put in, can be withdrawn at any time without tax or penalty. If you contributed $50,000 over 10 years and face a real emergency, that money is accessible without triggering a penalty. The growth stays locked until 59.5, but your contributions are always reachable. Many people in their 30s treat the Roth IRA as a secondary safety net for exactly this reason. With a traditional IRA, any early withdrawal before 59.5 triggers income tax plus a 10% penalty on the full amount. The narrow exceptions: first home purchase up to $10,000, permanent disability, certain medical expenses, do not cover most real emergencies. In most cases, early traditional IRA access is genuinely costly. On the retirement end, traditional IRA requires you to start withdrawing money at age 73. The IRS calls these required minimum distributions, mandatory taxable withdrawals, whether you need the cash or not. They can push you into a higher tax bracket and increase your Medicare costs when you least want surprises. Roth IRA has no required minimum distributions, ever. The money can grow tax-free for the rest of your life and pass to your heirs with continued tax-free treatment. That makes the Roth a fundamentally different wealth transfer vehicle from every other retirement account. Can you have both? Yes. You can split contributions between Roth and traditional in the same year, but the combined total cannot exceed $7,500. Some people split as a hedge against tax rate uncertainty. You are not locked into a single choice for life. The verdict based on where most people actually are. In your 20s or 30s, under the 22% bracket or close to it, and your income is likely to grow. Roth IRA. High income year, in the 32 or 35% bracket, and you have genuine reason to expect your retirement income drops to 12% or below, traditional or backdoor Roth, depending on your income level. Over the Roth income limits, max the 401k match, then backdoor Roth. Do not let the income limit be the reason you miss out on tax-free growth. Changing jobs with a 401k, rollover to a traditional IRA to preserve tax advantage status, then evaluate whether a Roth conversion makes sense in that tax year. To open a Roth IRA today, Fidelity, Vanguard, or Schwab. All three have no minimum to open. Create the account, fund it with what you can, and invest in a total market or S&P 500 index fund. The limit is $7,500, $625 a month to max it. Start with what you have and increase as your income grows. Bella chose the Roth because she wanted certainty. Pay the tax now. Never worry about it again. Aria chose the traditional because she wanted the deduction today. One of them retired with $1,125,659 and never wrote a check to the IRS. The other is still calculating. Drop a comment, Team Roth or Team Traditional, and tell me, do you actually believe tax rates will be lower in 2050 than they are today? None of this is tax or investment advice. Rules change and your numbers are unique. Talk to a licensed professional for advice specific to your situation. Subscribe for more videos on how money actually works and how to make it work for you. See you next time.